What's up, West Michigan? My name is Adrian. I'm a local realtor here, and today we're going to be going over different types of loans that you need to know about before getting yourself into a home. Now, before we continue, my information is popping up here on the screen. I'd love to help you with buying, selling, or even getting into real estate investing. Give me a call. I'll be the one answering all those text messages, emails, and phone calls, and I'd love to help. All right, let's go. So the main reason why I'm making this video is because there seems to be a lack of knowledge about the different types of loans. Most of my clients, they go to the lender gives them whatever they get, and that's what they go with. Not necessarily a bad thing, but sometimes there are other options that if you were made aware of, you probably would have went. And so before you get yourself into a no home here in 2023, I'd like to go over some of those with you. All right, so the first one we're going to be covering is going to be what's called a conventional loan. So most of these, all of them except for the investment loan here at the end, are all going to be backed by the federal government. They all have standardized rules that the lenders are required to follow to give them to you. So conventional is 3% down as a first-time home buyer. Now, if you've owned a home in the last 3 years, you are not a first-time home buyer, at which point those rates go up. However, if you've owned a home 4 years ago, you are now a first-time home buyer again. Congratulations. So 3% down, you're going to wind up having a lot less strict requirements than the other types of loans. The main thing is your credit score and debt to income are going to need to be better than what you would be able to get pre-qualified for FHA or any of those other kinds of government-backed loans. So the main change between conventional and the other types of loans as far as what you can get with that loan is it's a lot less strict. That could be a good thing or it could be a bad thing. If you're looking for something you can buy that's a good deal that you can then fix up, and because of that, you're getting a discount on the value of the home and you wind up making money on it, more power to you. Conventional is probably the way you got to go. The requirements, as they've been explained to me, are you need to be able to have a working bathroom, a working kitchen, and a usable living space. And as far as loan requirements go, that is very loose. So if you want a fixer-upper that maybe is just ugly or part of the house is livable, then that may be the way to go for you. It's the same thing if you find some of those old, neat churches that have been rezoned residential and you want to turn them into a single-family home. You can, as long as they meet those requirements. You can buy it on a conventional loan, move into it, and fix it up. All right, now the second loan type that I want to go over is FHA. FHA is probably the most common loan type that I see out here. FHA is an amazing program. Just like conventional, it can work with MISHDA. Out here we have Chinawa and some other down payment assistance programs. However, different from conventional, it requires 3.5% down for first-time home buyers. So you're looking 0.5% up on your down payment. Now, the main difference is that FHA kind of give you some protections because they require the home to be up to a certain standard for you to buy it. One thing that I forgot to cover here in conventional is that each type of loan here has their own appraiser. And that appraiser is going to check on the condition of the home and see if it fits the standard of the loan. So a conventional appraiser is going to look for different stuff than a FHA appraiser for stuff that could disqualify. Now, for FHA, they're going to be very strict. The home needs to be in good condition. You can't have peeling paint on the wall. The home can't really be in disrepair. If you have any structures that are falling apart, they have to come down or be repaired. If there is a major line down the center of your driveway and half of it's raising up and messing up the structure of a garage, that garage may have to be removed. It sounds like a lot, but it really does offer protection for first-time home buyers who don't know what they're getting themselves into, because the repairs that they require to be done besides stuff like the peeling paint can be very, very expensive. All right, now the next thing we're going to go into is USDA, or Rural Development. Now this loan excites a lot of people because it is 0% down payment. You still have to come up with closing costs, just like every other loan. Those closing costs are your taxes, your home insurance for the year, and any fees that the lender, title company, realtor have, like admin fees. The main difference is that 0% down payment really does make it easy to get into, especially with all the down payment assistance programs you can get involved with for first-time home buyers. Now, the big thing is you need to go to USDA.gov and take a look at their map. It's going to be color-coded and tell you what areas qualify. Now, USDA, the whole point is to move people out into more rural areas. So this loan only works for areas that are less densely populated. So if you're looking here in West Michigan, if you're looking in downtown Muskegon, it's not going to work. If you're looking in Grand Rapids or Grand Haven or Holland, it's not going to work because those areas are larger cities, at least for this part of Michigan. However, if you start looking at Whitehall, Montague, Hart, Ravenna, Sparta, those areas all are outside of bigger cities, but they themselves are not very densely populated, and therefore you can get the 0% down loan. Now, USDA or rural development loans are not super popular. There's just not a lot of knowledge about them that's going around, at least in my area. However, if a house would qualify for FHA, it's probably going to qualify for rural development. They have very similar requirement. Again, it offers some buyer protection because you're going to guarantee that that home is at least meeting that minimum standard to be a comfortable living house. Now, the next one I'm going to go into is VA loans. Now, VA loans are actually a little stricter than rural development and FHA. Again, this is a 0% down program. If you served in the military or if you have a spouse who has passed away who served in the military, this loan is going to be an option for you. Again, you don't have to be a veteran directly yourself, but it only can be taken over by a non-military service member if it is a spouse of a deceased veteran who had that benefit. Now, unlike USDA, you could buy a house anywhere you want with this VA loan. The main thing is that it has to be a primary home that you plan to live in, and you meet those minimum requirements for service. It's a great loan. Now, when I say it's more strict than FHA, what I'm talking about is with the FHA, maybe they'll call peeling paint, or you got foundation, plumbing, electrical issues. With VA, they're going to go a step further. They're going to make sure that every railing is sturdy, every staircase has a railing, and that any peeling paint on an outside structure or the main structure is all taken care of. And so they just take it a step further, but at the same time, having those to ensure that you're getting a good home is not a bad thing if you are a buyer. It may be a pain if you're the seller, but you can still work around them because the more loans that you open up to as a seller, the more likely you are to get either what you're asking for the home or a higher price, because it opens it up to a larger pool of buyers. Now, the last loan I'm going to go into is a local loan that a mortgage broker I work with over here, his name is Steve Frost, does that I have not seen anybody else do. And it is through a private lender. And what they do is if you're looking for an investment, this is what they call an investment loan. At least that's what they named it. And you're going to wind up have 20 to 25% down, depending if you're buying a single family or multifamily, potentially more depending on the number of units, but it can only go for a 1 to 4 unit residential. It does not require any kind of proof on your income or debt to income. The main thing is they want to see you have a good credit and that you have the down payment. Some of the restrictions on that are you either have to prove that you already have a track history with investment properties on knowing how to turn them profitable, or you have to show that the property you are buying is profitable either in monthly income or statistics for Airbnb or whatever route you're going with this for the investment. Well, that's going to be it for today. If you have any questions, contact info's here on the screen. Please give me a call. I'd love to help you. All right, have a good one.